Vamos a hablar en los próximos minutos con Brian Vendig. Él es presidente y Managing Executive de MJP Wealth Advisors. Brian, thank you so much for your time and for giving this interview to Negocios Televisión.
Sure, my pleasure.
Brian, which scenario do you see currently in the stock markets?
Sure, I think markets right now have definitely been a little bit more volatile as we've moved through some changes in tone from the Federal Reserve regarding inflation expectations, and obviously policy changes coming from Washington, which are seeming to resolve themselves. So we're still optimistic about a global recovery playing out over the balance of the year into next year as we move through supply chain inefficiencies and as people continue to get back to work, as more vaccinations and therapies help the services and industrial parts of the global economy.
Mm-hmm. And which factors are driving investor sentiment?
Sure. I mean, right now we're on the cusp of earnings season starting next week. So investors are definitely waiting to hear how companies are dealing with the supply chain issues, and is that going to impact company profits and sales. At the same point in time, I think investors are waiting to hear about tax policy changes in the U.S. and also outlooks for companies when we think about demand as we move into next year. So I would say overall, right now, investor sentiment in the short term has been a little bit pessimistic because of this wait and see that we've been in on earnings being around the corner, as well as trying to hear about some policy decisions that Washington is making. But I think longer term, looking at the indicators, investor sentiment is still very positive and robust for the markets moving forward.
Mm-hmm. Well, still very positive. And in US, Brian, this week we are monitoring the labor market. We've seen progress in September with the addition of 568 private payrolls, and we're expecting to know non-farm payrolls and unemployment rate this Friday. How do you see these improvements, and what can we expect from the Federal Reserve?
Sure, definitely. That's a great question. I think the labor markets are continuing to take a little bit longer to heal. I mean, directionally, the numbers that came out this week, the unemployment claims today, the ADP number, and of course the jobs report on Friday, is going to probably show that we still have a decent amount more room to grow the labor market, and there's still 11 million jobs available. However, it does seem to be that now that extended enhanced unemployment benefits have expired, more people are re-engaging in the labor force. And I think the Federal Reserve is going to tell us that because the wage labor environment, the labor force is taking a while to get people to get back to work, and the service sector of the economy really hasn't reopened, I don't see that there's going to be any changes with interest rates. But we are probably going to get some clarity from the Fed that quantitative easing or the bond buying will probably begin to be weaned off or taper, as those would say. And that probably would start sometime, we guess, between November and January of next year, November of this year into January of next year. Really don't see that as a very big event in the financial markets. I think investors are expecting that. They're really more curious about the dot plots on where we think interest rates are going to go relative to concerns that inflation probably will be more persistent until the summer months next year.
Mm-hmm. And if we look at China, Evergrande remains as a threat, and maybe its downfall is not a limo moment, but China growth could take a hit. Do you see a property bubble in China?
Yeah, so that's another great question. In China, you're absolutely right. When you look at the individual wealth of Chinese citizens, a significant part of someone's wealth is based on real estate. And when you take a look at the debt to income ratio of Chinese citizens, it's sitting at around 40%, which is about double what you would expect historically for Europe or for North America, for example. So I think the Chinese government recognizes that there definitely has been some speculation, as well as some relaxed liquidity measures, and they are taking steps to make sure that the real estate market has a soft landing. I think at the same point in time, the Chinese government is very focused on policy developments that are going to come together in October of next year. And as a result, they're really trying to ensure that overall across their society that there is a way to manage some of the income inequality that has happened over the years as well within the country. So I think Chinese government is very focused on trying to make sure there's a soft landing in the real estate market, but it's definitely something to watch because I do agree with you that some of the lessons learned in other countries are now playing out in China, and the real estate market can definitely influence the overall economic output of that country if there are not productive reforms that will happen. But it seems like the Chinese government is getting involved to try to help to support the markets, and we hope that continues moving forward.
Mm-hmm. And what can we do with the current volatility, and which assets are you focused on?
Absolutely. So I think when we think about the market moving forward, we are still focused on that global growth story, as I mentioned previously. So investing in cyclical stocks such as basic materials, industrials, those are the sectors that are going to help to support the supply chain management, the ability to get raw materials to the market to support future orders, as well as when you think about the 5G revolution or alternative clean energy. We also still like financials because we do expect interest rates to go up over the next 12 months, and that definitely helps financial stocks. And lastly, I would mention real estate is really an interesting opportunity right now. So many people have discounted the real estate market because of what happened last year, the height of the pandemic. I think you should think about industrial sector real estate, life and health science real estate, apartments. Real estate's a great hedge for inflation and something that can also add some income to a portfolio, which is a nice alternative instead of just owning traditional bonds.
Brian Vendig, President and Managing Executive of MJP Wealth Advisors. Thank you so much. It's been a pleasure.
Thank you as well.